Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Welcome to my podcast. Okay. Over the weekend, I got so sick of hearing how, we had a 1,200-point rally because what's going on with the strait, the blockade's doing beautiful. Blockade had nothing to do with a 1,200-point rally. People don't know what they're talking about, all these jibber-jabbers. So all week long, they've been giving out just really bad information because the real reason behind Friday's 1,200-point rally had nothing to do with how swimmingly the blockade is doing, as Trump said. All it had to do with, we got a report that inflation was higher than they expected. That put fear into traders that, we're not going to get a rate cut. So they panic. And when inflation comes in, and it's lower than, higher than expected, they panic. They start buying safety. They start buying bonds. So when they started to buy bonds, that's what happened. Yields started to go down. So report, inflation's getting hot, panic, buy bonds, institutions buy more bonds, yields keep going down again and again. And what happens? It's over. That we have, again, this big AI rally. So that's what went on. It had nothing to do with the blockade. It all had to do with a big rally in tech stocks. Because, again, yields went down. Well, the other problem it had, too, is that you only had 3 stocks that causing the rally. We had terrible narrow breadth. Now, when you have narrow breadth, when you have only 3 stocks driving a 1,200-point rally, that's pretty bad. Google, Nvidia, and Amazon. So what happens when you have terrible narrow breadth like that, this tells you that the relief rally is bad. It's very weak. It's not going to last. And this relief rally has been going on since March. And everybody's been saying, what a great rally. No, it's not. It's a relief rally. And it's driven by 3 stocks. And it will stop at some point. And when is that? When everybody who shorted, and now they're buying their stocks back, when they have all their stocks back, completed, they're done, there's no more fuel to move the market up. Now, if institutional money was coming in and they got out of the bond market, sure, we'd have a great rally. We'd have a bull market rally. That's what we're looking for. But everybody's treating this rally as if it was a bull market rally because you're being lied to by the jibber-jabbers in the suits on Wall Street. This is a terrible rally, very fragile. In fact, not only do you have just 3 stocks that are driving this rally, short covering, but the Buffett indicator, I want to show you something. Watch this. Go to my chart. If you look at my chart here, this is the Buffett indicator. Market cap to GDP. Well, we knew back in 2000 when the Buffett indicator hit 140, that was a big warning. And right after, bam, we had a crash. Again, when we saw that market cap to GDP in 2007 was really bad, and we knew then that we got a problem. And what happened was the Buffett indicator comes in back then in 2007 with 115, and the market crashed. Never wrong, the Buffett indicator. But look at this today. The Buffett indicator today is at over 227. That's nuts. Why? Because there's only 3 stocks driving this whole rally. So it reflects 3 stocks. So that's nuts. So that tells you the market is more overvalued today than any time in modern history. And people are still jumping in and buying. So a handful of mega cap stocks is driving this rally. There's no institutional money. The minute that the short covering stops, and if the institutions don't come in, it's over. We're going to have a crash, and we'll have a beautiful crash. We'll short and we'll make a lot of money. But that indicator is always right, never wrong, and I'm surprised it hasn't crashed already. But here's why it hasn't. Because the jibber-jabbers on TV in Wall Street keep on pumping this market, this economy in Washington, the greatest economy in the world, and people are buying into it. And so, but they only can do that for so long, and then it goes away. Now, the other thing that's interesting, if you take a look at some comparisons, I think I have them here for you. I hope I do. I prepared them. Let me see if I can find them for you here. Yeah, here they are. So if you compare, make sure I got this right for you. I don't want to give you wrong numbers. That wouldn't go over well. Okay, so let's take a look at gold. Now, gold only rallies when investors want safety. And stocks only rally when investors want risk. Stocks are risk, right? Unlike bonds. Now, when both are climbing at the same time, it means investors don't trust the rally, and they're both climbing at the same time. So you got the Buffett indicator, you got this other indicator, gold versus the dollar, and it's telling you this market is seriously, I mean, it's just, there's no strength anywhere in this market. It's hanging on by a thread. And every time yields go down, and every time that happens, the buyers on a dip, we call them the dips, they jump in and buy tech. And they're going to get killed. And one day they're going to wake up in the morning and they're going to get slaughtered. You can't have a market like this. It's just crazy. So, and then when both are climbing at the same time, it means that investors don't trust the rally. Now, that's not good. And measure the S&P in dollars, everybody's happy. It's making a new high. Measure the S&P in gold, that high disappears immediately. It's gone. So watch the Buffett indicator. That's the one that always tells you the truth. And what else tells you the truth? Is yields. Yields will always tell you when the market's going to crash. And IWM will always tell you or confirm the crash. When yields are heading towards 240, 250, that area, it's going to crash. You want yields heading down towards 4%, not 2.5% or 4%. You want them to head down to even 3%, 3.9% would be great. But we don't have that going on right now. Okay? So yesterday, when everybody was buying bonds and yields went down, everybody was really happy. But they don't realize that, it's over. Now, it's just a matter of time, what I mean, is where you're going to get a big correction or even a crash. Well, how do you stop that? What do we need to get this market rallying again? Well, simple. You need to have investors from Europe buying stocks, stocks again. They got to come in and start buying. And you need foreign money, right? breadth must start expanding. Yeah, I've got a whole list for you here. I wrote them down. Inflation has to be cooling. It came in hot. And again, none of this is working. You need yields heading down towards, as I said, 4%. So this whole thing is, every day we're being told, oh, Iran, we're doing great, we're doing terrific, we're going to give another 10 days, and the market goes up and goes up and goes up on that noise. But it's not really going up on that noise. I mean, some stocks are, of course, okay? And people are jumping into dippers and buying. But it's the yields that tell us the truth. And as long as yields keep heading down, we're going to be just fine. And that's the big problem. I got my little partner here. He doesn't agree with me right now. He's getting upset. No, he thinks yields should be going up. He's still arguing with me. Anyways, we have a, come here. Come here. Here, what's this? Come here. There he is. This is, everybody remember Bud the stock dog, right? This is Doodoo, the stock dog. Say hello. Doodoo the stock dog. But he's a little upset with his yields. I know. Yeah, I know. Yields will come down. But Doodoo agrees with me that this is a big relief rally. It's all it is. And you can see it every time. They'll turn around and say, oh, God, we were lucky. We thought they were going to start bombing again. They did. Here's an interesting thing. I'll go to my chart. This is interesting. When you start looking at stocks, you got to start making sure, as long as you've got this relief rally going on, this fake rally going on, this dangerous rally going on, you got to make sure you're not chasing stocks where stochastics are at the top. You got to be buying stocks where stochastics are at the bottom, near 40, 45%. Now, example, if you put up on your chart, and I'll do it here, you put up on your chart, okay, VTR, okay, nice stock. Now, VTR, the stochastics, are around just almost about 85. Normally, I would buy this stock, especially if it broke above the high of March 18th. But that's not what's happening right now, because I wouldn't buy it, because it stopped going up because there's no more shorts to cover. The shorts are done covering. So if we had the institutions participating normally, they're coming in trading normally, this would be a great stock the minute it broke out. But you got to stay away from those stocks. You got to stay with stocks that are down near 40%. If you stay with stocks near 40%, 45%, you'll be okay. But stay away from those high yield, those high stocks near 60, 80 on your stochastics. You'll get killed. Okay. Now my partner and I are going to discuss some stocks, right? Okay. You trade first. I'll trade second. See you on the charts.